Yes, today this is the Retirement Education Hour. It is always a pleasure to be sitting here in the studio once again with financial instructors Kirk Cassidy and Michael Mazarin. They are both with the Retirement Education Foundation. As you know, the foundation brings you this show. They also make it possible for you to attend courses on retirement. We tell you about these each and every week here on the show, and these are like master's level courses held at major colleges and universities right near you. Throughout this program, we'll be telling you how you can reserve your spot so you can walk away with even more confidence about this next stage of life called retirement. And speaking of retirement, a lot of people who are retirement-minded right now, Kirk and Michael, they're thinking about the markets. They're looking at this volatility, and they're thinking to themselves, how do I make the right moves given all of the emotion that I'm feeling right now? And it is a roller coaster, and I don't blame a single person out there listening today who is nervous, who is, apprehensive, who's panicked, who's frozen. How do we navigate all of these psychological impacts given the volatility we're seeing right now?
Well, I think, Megan, we have a different perspective of this. As being a national charity, we're teaching these 8-hour courses in universities, right, around, in all your local areas, major universities. And we've been doing this for over a decade now. And so teaching tens of thousands of people, watching how people come into courses, where their confidence level, where their anxiety is or isn't, is really, there's a lot of common themes that we see. In the 50s, you feel like you're invincible. In your 60s, you start to have anxiety. And in your 70s, you start to have pretty significant fear. And there's a lot of research around why this is. This isn't something new. This isn't a revelation. We've known this even before we taught the classes, but witnessing people in their 50s, 60s, and 70s well over a decade going through different major market events and really good markets, we see the same pattern. And we know, I think this is show something like 250 or something. We've done hundreds of shows on radio now. And so we know who's listening. We know the people who are attending the classes. We know their education level, their sophistication level. We know most of the people listening to our shows have somewhere between $1 and $10 million of investable assets. They're highly educated. These are a lot of engineers, right? I know you're listening to us. That's who's coming to our classes, the executives, the highly educated CPAs, attorneys. And they're all so freaking overconfident, Michael, and they just think they're different. And I'm not picking on you guys. I understand why people feel that way coming out of what was the greatest bull run in market history. We had a decade of really incredible markets and not a tremendous amount of volatility. No wonder people are struggling right now.
Well, the challenge for a lot of these people is that the game sort of changes on them because in one regard, they are different. That these people who've done a really good job saving for retirement, because the average when you're in the game of growing your wealth from your 20s through your 50s, accumulating wealth, growing your wealth, the average baby boomer retires around age 65 with approximately $200,000 saved for retirement. So the person who has saved $1 million, $2 million, $5 million, $10 million, that person is different when it comes to the growing your wealth game. They have played that game significantly better than most of the people in their lives and most Americans. And so in that regard, they are different. But then they start to change the game from the grow your wealth game to, okay, how do I understand when can I afford to retire? How much can I afford to spend? How do I start to withdraw the wealth and maximize my cash flow, minimize my taxes? And the problem with that is when you change the game, they go from being in the top 1% of the grow your wealth to now they're on the same footing as everyone else in terms of no one really understands how do you withdraw the money properly. And so the confidence they had from being really good on the grow your wealth game carries over, and they assume that confidence will keep them, ahead of the pack when it comes to withdrawing the wealth, and that's not the case.
So, Michael, these are some of the things we talk about in our 8-hour courses. I'm going to encourage anyone, no matter where you're at in terms of your financial wealth, and if you're within 10 years of retirement through retirement, to attend one of the charity's 8-hour courses. If you'd like to register, go to retirementplanningedu.org. That's retirementplanningedu.org.
For the person who's done a really good job saving a lot of wealth, they tend to think, okay, I've done a great job saving all this wealth. I've been studying the stock market for a long time. These are the same tools that I'm going to use to guide myself through retirement. But that's when they realize, wait a minute, the game's changing here. It's not about just take a lot of risk and let the market grow over time, because I can't deal with the volatility as well as I used to be able to from two perspectives. One, psychologically. Now it's more stressful. You don't have time anymore. And number two is that we don't have 10, 20, 30 years to let it recover. When you're 30 years old and the market falls, you have 10, 20, 30 years ahead of you to let it recover. That's not the case anymore.
I think part of the problem, Michael, and it is a problem. Look, and we're going to talk a lot about psychology, behavior, how you should be reacting during times of market volatility, how we know you will react. Listen, please hear us. I know we all think we're really smart and talented and really good at everything we're doing. And a large percentage of the people who are attending our classes and listening to our shows, you're at the peak of your careers. You're making the most money. You're very confident in whatever it is your profession is. You're very confident because you've seen your wealth significantly grow over the last decade because of compound interest and making more money and saving more money in the greatest bull market run in market history. So you've got all this overconfidence, and it really doesn't hit you until you realize I'm still working and I don't know why I'm working. We have major market events. I don't know why I'm starting to feel this anxiety. And you start to recognize, wait a second, okay, there really is a different strategy, mindset, relationship when it comes to retirement. And what we want to do, and the purpose of our charity is to show you, unfortunately, most of the people that are providing retirement services in our industry are not aligned with you. Their goal is not to see you to be able to spend as much as you can, retire as early as you can. The incentives are not aligned. There is a conflict. And so one of the main goals of this class, not only to teach you the strategies to be able to maximize your income, pay less taxes, and retire earlier and have less anxiety, is how to find the right teams to help you. And we give you the tools to do that. So if you'd like to sign up for one of our 8-hour classes, all we ask is for a $29 donation to charity. We teach them in 2 evenings, 4 hours each evening, or one full Saturday, 8 hours, and we teach at most major universities and colleges in your area and stream it live from the universities. If you'd like to attend, go to retirementplanningedu.org. That's retirementplanningedu.org. Thanks for listening to the Retirement Education Hour. Be sure to follow or subscribe when listening on Spotify, Apple Podcasts, or wherever you listen to your podcasts. And now, back to the show.
As we talk about this today, I do want to point out something I've observed. You know, if they're over the age of 50, they've seen significant market volatility, Kirk and Michael. But what I'm seeing right now is that age group, they seem even more spooked than normal. Are you seeing that? And why do you think that is?
Well, that's a loaded question. I mean, if we really want to dig into this, there's a lot of variables. Without getting into the political discussion of the whys, there's a lot of motivation and there's a lot of reason for news organizations, financial service industries, for the media to lean into fear and anxiety. Fear and anxiety sells. It may also support a narrative one way or the other, depending on what political disposition you align with. And again, I'm trying to do this without offending anybody, but I can tell you, we go through the same type of anxiety, and people don't want to accept this, but the same type of anxiety when different administrations are in office, depending on who's in control and what the policies are, people begin to get anxious and fearful. Now, when you align that with what is a pretty major policy change, almost a restructuring economically for the U.S. right now, we'll see what happens, and extreme number of baby boomers retiring. I mean, we're at the peak of, I think it's over 12,000 baby boomers a day retiring right now. And we see Michael is talks about this all the time. We've seen a market pullback that happened very rapidly, very quickly. I, by the way, don't think that's going to change. I think every decade we're going to look back and say, oh my gosh, this was a massive drawdown very quick. I just think, we've got just the technology today allows things to trade much quicker, and the algos trigger things quicker. I don't think that pattern's going to stop, but you add these things together and you have a lot of anxiety and fear.
So you're exactly correct in a couple of things. Number one, the speed at which this stuff happens. News travels faster. These algorithms can trade at the blink of an eye, billions of dollars. There's leverage being thrown around everywhere. And that's why we see these massive intraday market swings. We had an intraday market swing of 7% during the day a couple weeks ago. These things are unbelievable. And so all of this volatility just piles on to the fear. And this starts to kick into people's primal survival instincts of fight or flight. People have this nest egg they've been watching grow over the past 10, 20, 30 years. And now all of a sudden there's this primal instinct, fight or flight. They see the number drop 10% in 2 days through not any of their actions, but actions of other people that they may or may not like and may or may not agree with. And all of a sudden their instincts kick in to protect themselves. And the only way they know how to protect themselves is push the sell button. And it's fascinating. I mean,
push the sell button, and I want you to keep going, but push the sell button or not retire or not go on vacation or not do a home improvement project, allowing this short-term event to drive life decisions.
And one of the things that you start the class off with very often is, the Mike Tyson quote, everyone's got a plan until they get punched in the mouth. And it's fascinating, and it's a little sad that if you interview these people who are panicking right now, if you interview them in 2023 or 2024 saying, when we have volatility in the stock markets, do you think you're going to panic? They puff out their chest and they say, oh, me? No, I've never panicked before. I never will panic.
Especially those 50s that are invincible.
And it's really easy to say that, to be rational when the market's up 20%. In 2023 and 2024 were unusually calm years. We have very small volatility, small drawdowns those years, 2 strong back-to-back years for the stock market. So it's really easy to be calm in those years, and people pride themselves on when there is volatility, I'll be rational. But when the volatility starts to kick in, people find that they justify it to themselves. Well, this time is different. People always say it's different this time. COVID was different. 2022 was different. This time is different. This time it's political or whatever. And they justify it. Well, I'm not panicking. I'm protecting myself. It's the same thing.
The markets just go up over any extended period of time. It's irrational. One of the things we really focus on, and I'm sorry to interrupt, but we're going to run out of time. I want to make sure the purpose of this show and the purpose of the charity and the purpose of the class is to really give you the tools to not allow these short-term market events to impact you at all. Like literally nothing. In fact, it's just all it is an opportunity. It's an opportunity to Roth convert if you're already retired. It's an opportunity to take advantage of the bonds market. I mean, we locked in our private practices, 5% yield to worse on tax-free munis for the next decade. I mean, okay. So if you're not fearful during these times that are going to happen every 4 to 6 years, you can take advantage of it. And in no short-term market event should force you to change your spending patterns. You should continue to plan to retire if you're going to retire. You should spend, go on vacation, do everything if you have a properly structured retirement plan. Money and annuities like other people on these radio stations tell you to do. Okay? So attend one of these 8-hour classes, and we will teach you how to find the right teams to have you have the retirement you want. Go to retirementplanningedu.org. That's retirementplanningedu.org. Listening from outside Michigan or Missouri? We stream courses live from the university so you can attend anywhere in the country. Go to retirementplanningedu.org. That's retirementplanningedu.org to sign up. And now back to the show.
Want to get back to our show? Keep in mind, you can download this show as a podcast wherever you find your favorite podcasts. Simply search for the name of our program, Retirement Education Hour. So, Kirk and Michael, I have a question on something I've noticed. oftentimes when people are nervous, they tend to act out, do things. In the case of people planning for retirement, maybe they're purchasing products that aren't even good for them. Is this just a fear-based response? Why do people do this?
Well, Megan, so this is the part of the financial service industry that's, in my opinion, very ugly. Right? I mean, at the end of the day, I think people need to be on guard because it is a sales business. It's a business of sales. I know it's supposed to be a business of service to provide advice and coaching and assistance. But unfortunately, just listen to the local airways, just like this radio show now. Unlike us, we're a charity and we're promoting education. So if you listen to the other shows, fear, market volatility, bad things happening in the market triggers a lot of responses, behavioral responses that makes their jobs easier in selling things that may not be best for you. One of those behavioral biases that are triggered during these very volatile times is loss aversion, especially as we're approaching retirement or in retirement. That fear of losing our money, and they can sound so convincing on the radio and their TV shows, the safe money strategies. So listen, I know everyone on the local radio markets, on TV markets. I know the firms, the charities done research. These are insurance salespeople that sell predominantly insurance. I just heard one last weekend that's commonly on in Ohio and in Michigan. They were talking about 60, 70% of the money going in fixed indexed annuities because you have what you need to give you what you want. And you may have what you need to give you what you want, but you want more than a 4% rule. You want to be able to spend 6, 7, 8, 9% per year. You would like to have a controlled spend down of your principal. I want to be clear. I'm not suggesting that annuities are bad. Some are. I will say 90% of people getting sold annuities are being sold the wrong annuities. They're buying products based upon fear. They take these opportunities of your fear of loss aversion, to sell you products, insurance, to convince you to spend less. Just remember in the back of your mind, everyone, the less you spend, the more your advisors and the people managing your money earn. They make money by managing more of your money. So the less you spend, the more they make. There is no incentive to convince you to spend more money and teach you how you can take 7, 8, 9% withdrawal rates. There is no incentive at all. It's a lot easier for you to protect your principal, spend less during times of volatility, buy a bunch of annuities that protect you against inflation or protect you against market loss. I can personally tell you, Michael, I'll throw it to you right now. We've been in the business. We manage billions of dollars. We've been in our private practices. We are volunteers for this charity. It's the reason we volunteer for this charity. It is the reason, is that we see how people are taken advantage of. I can't imagine you don't need that much insurance. 30%, maybe 40%. You don't need that much insurance to be effectively. You got to take advantage of the market so you can have more income in retirement. It's just, when do I take what income from which accounts? That's what we teach in the class.
Well, so you mentioned earlier loss aversion, and down to it, loss aversion, the pain of losing 10%, when people think about their portfolio, the pain of losing 10% is greater than the happiness when they gain 10%. The pain of loss outweighs the happiness of gain. That's what loss aversion is at the core. And they take advantage of this. The annuity salespeople, they say, okay, well, the market's down and it might go down further, so we can stop the pain. We can get you out. We can protect your downside. And that's what people want to hear when they're hurting, they're down, markets are down, there's a lot of uncertainty. They want to hear, I can be safe. And they will say, look, this is going to cap your upside. And in the moment, people go, okay, I'm okay with capped upside, because the thought of more downside is more painful than losing some capped upside. But the problem is, you might not be spending those dollars for 5, 10, 20, 30 years. If you're not spending
some of your dollars.
If you're not spending some of your dollars for 10, 15 years, you don't need downside protection. You need coaching to understand that, no. These dollars have time to recover. Do not panic. Don't cap your upside. These dollars are going to be okay. The dollars you're spending the next 1 to 5 years, you need some downside protection. That's what the plan is. That's what building a plan for yourself can do. But those longer term dollars, you don't need the downside protection. You need coaching for someone to coach you through this. That's why it's so important to have the right team around you.
Yeah, and so that's what we teach in the class. How do you find the right teams? And we'll teach you what questions to ask, how do you do background checks, what a plan should look like, what different levers should be included in a plan so you have dollars to spend during times of market volatility. You shouldn't change your spending patterns. If you plan to retire this year, you should have a plan that doesn't matter what's happening, because these events aren't going to stop. We're going to have events like this every 4 to 6 years. So you shouldn't have to change your spending pattern. So attend one of our 8-hour classes. We'll teach you how to find your teams. If you'd like to register, go to retirementplanningedu.org. That's retirementplanningedu.org.
Classes are forming now. Go to retirementplanningedu.org to register. Again, that's retirementplanningedu.org. Use the promo code PODCAST to receive 50% off your tuition. And now, back to the show.
Okay, so Kirk and Michael, we've talked previously. I've heard you say the best days in the market often follow the worst days in the market. And sometimes you say that people miss out on opportunities, and it's all because of fear. Tell me more.
Megan, look, so again, national charity, decades, taught over tens of thousands of people, major universities. That is what we do as financial instructors. All of the instructors are part of the Retirement Education Foundation. I also have a private practice. And in my private practice, we're like a family office for high net worth families. So I've taken care of high net worth families for decades. And we see a common thread. The behavioral biases around markets, market volatility, and anxiety are consistent from a financial perspective throughout. And even though most of the people attending our class, they have some good foundational financial literacy, they're smart, intelligent people, they know the data. I mean, you can go to Chat GPT, you can check any of the AIs, and they're going to tell you the same thing. The data is clear. No one can stock pick in market time. No one can market time and navigate around market volatility. No one is that good. And reducing your spending during times of market volatility is not freedom in retirement. That's not what you worked 90,000 hours over your lifetime to have to be careful about your spending because we're going through a recession or whatever market event that happens to be occurring at the time. That's craziness. You can have the freedom to spend 6, 7, 8, 9% withdrawal rates if you find the right team. That is the purpose of our charity, is to protect our communities, to help you have the retirement you've earned after so many years of working. And here's the thing. We can prove the data to you. We know the best days in the market are after the worst days. We know that 75% of the best days in the market, 75% of the best days in the market occur during a bear market, during the worst times in the market. Only 25% of the best days occurred when we have bull markets, when the market is just roaring. Only 25% of the best days in the market are during the best times in the market. Isn't that crazy? Michael, the one that blows me away is, what's the 7-day per year rule?
So on average, and every year is different, but on average, the total annual return comes majority from 7 days during the year. So on average, 7 days throughout the year, no one knows when, what month, what quarter they're going to happen. On average, at 7 days throughout the year, make up for a majority of that year's annual return. So if you miss 1 or 2 or more, God forbid more, of those best 7 days on an annual basis, you're basically not going to get the return that year. And that cripples your compound growth on a go-forward basis.
Michael, in the last couple of weeks, I've seen multiple people on CNBC that are financial advisors. They manage money and they're financial advisors. Come on and say, my clients are freaking out. They're only down 10%. They're worth millions of dollars and they won't go on vacation. They're canceling They're country club members. They're reacting ridiculously, and that needs to be avoided. None of you need to be afraid. Also, none of you should be trying to stock pick. You're wasting your time. Like Kramer has been wasting his time for decades from an investment perspective. He's a great entertainer. I know people love him, and he does a good job of educating people about markets. He really does. He gets people interested. But he's a horrible investor. He literally has underperformed the S&P 500 by almost 100. I think it's a little over 100% over the last 20 years. He's not good at it either.
I don't mean to pile on to Jim Cramer, because I do totally agree. He's very entertaining, and he's very educated about all these different stocks.
Tons of resources.
But for people who rely on him for stock picks is just baffling. And this is, I mean, honestly, back in 2022, he was crying on air about how wrong he was about Facebook stock, Meta stock. He was bullish going to a quarterly earnings. They got crushed. It fell. They had their worst day in 20 years. And he was crying on air about how he can't get this right. And that was the bottom. That was the bottom of 2022. So he was getting whipsawed left and right. So someone who's banking on Jim Cramer as their stock picking guru got destroyed. That can't be the solution.
That isn't the solution. It's not even... The investment part of this, Michael, is the easy part. It really is. All the time you guys are spending, I know you love looking at net expense ratio, recent market performance, Morningstar ratings. It's all nonsense. Go look at the Morningstar study and see how confident you should be about the Morningstar rating. You won't like the outcome. I think it was done in 2016 by the Wall Street Journal and Vanguard. They collaborated. Listen. Investing is the easiest part of retirement planning. It really is. It's not what's going to drive performance. It is your income planning that's going to drive performance. Where do I take income during different market conditions? When the market's up, where am I taking my money from? Where the market's down, where am I taking my money from? What blend of different strategies should I use? I mean, that's the easy part. It's building a plan, getting the right team to coach you, getting the right team to implement those strategies. It is really, the nuance of implementing strategies is hard because we got to take your total emotions out of it. So if you'd like to attend one of these 8-hour, almost master level courses, all we ask is you make a $29 donation to charity. If you'd like to register, go to retirementplanningedu.org. That's retirementplanningedu.org. To find our latest white papers and webinars, go to retirementplanningedu.org. That's retirementplanningedu.org. And remember to subscribe or follow wherever you listen to your podcasts. And now back to the show.
Okay, question for you about blind spots. You know, all of us have some, okay? Don't tell my husband that. But I even have some blind spots, okay? Kirk and Michael, and when we come into a very, very important crossroads like retirement, if we have blind spots, if we have prejudices, if we have preconceived notions, or we have ideas about things that are just very misinformed, how could that potentially prevent us from making the right decision for our finances in retirement? What's at risk here?
Well, Megan, I think what you're describing is something called behavioral biases, and it's something we spend a lot of time talking about in our class. We've designed our class around a lot of the behaviors as you're approaching retirement, in retirement, as you age, how you're going to react, why you're going to react, to help you to be a little more insightful and intellectually honest with yourselves about your finances and your behaviors so that you can produce the best outcomes. Is anyone that has tried to be really self-reflective on some of these difficult issues in our lives recognize that this can be painful and difficult. And it's one of the unique aspects of being an instructor for a national charity doing these classes. We're not there to build relationships. We're there to try to provide you the resources to have the best possible outcomes in retirement. And sometimes that is to challenge you and make you confront some of your inaccurate biases. So there's there's really three. I really wanted to throw herd mentality into this one. That's a big one. But there's two I'm going to throw to Michael, and we're going to talk about really quickly. One is confirmation bias. It's one of my favorites. Can you define that and describe that? And I'll use some examples.
Yeah, confirmation bias is really very widespread and wide-reaching across everyone's lives. It impacts almost everything we do. And it's just the tendency to search out information that you already agree with. And so the easiest example, not to get political, but the easiest example is politics. If someone likes a certain candidate, they're going to search for information or news that supports that candidate and information or news that attacks the opposing candidate. Or if you look at market events, if someone's very bearish on the stock market and they're Googling things like, is the stock market going to keep crashing and things of that nature? What's scary is that the algorithms are getting really good.
That's where I was going.
The algorithms pick up on, within 2 or 3 searches of Google, Twitter, whatever social media you're on, they pick up on, are you nervous about the stock market crashing? Are you nervous about which particular stocks are you searching about?
Are you nervous about Social Security?
Social Security going away. And they start to, all of a sudden, all the suggested articles, all the suggested links are curated to keep pouring that fear into your feed. And if someone's thinking, okay, well, I think this is going to bounce back, this is no big deal, the market's going to bounce back, and they're Googling, best stocks to buy for a comeback, they're going to start to feed you stories about this is a blip on the radar, no big deal. So you have people searching for all this different content, and they're really just looking for more ammunition to feel good about how they already think this is going to play out.
And that's so dangerous, Michael. And we're going to talk a little bit more about this, but that is really dangerous in retirement. It's not. You need to have a relationship with someone that can tell you things that you don't want to hear when it comes to your money. And you don't want to mix your money and your politics and your emotions around that, because that can cause you to make horrific mistakes. We've seen it so many times. The next one, Michael. Geez, almost called you Paul, because usually Paul would do this psychology show because of Dr. Paul Meller. Anchoring bias, another good one.
Anchoring bias, especially now when markets get volatile, can be really challenging, because anchoring bias, people get anchored to a number. So let's say, okay, well, before this market crash, I had $2 million, and now I have 1.6, and I need to get back to 2 million. I need to get back to that 2 million. Or they have this magical target in their brain of, well, I'll retire when I reach 2 million, 3 million, 4 million. They have this magic number they're shooting for. And I always kind of chuckle in the class, because people in the class will, kudos to them, they'll volunteer, look, I'm going to work until I have $5 million. And then the answer is always, why? Why is that the number? Why have you picked that magic number to all of a sudden you think that'll make you feel better? Because the reason people pick a number is because they think that once they achieve that number, that has to be enough, right? I can't possibly mess that up. Well, you might not need that much. You might only need 2 million or 3 million
I can tell
to
you
give
right
you what
now,
you
Michael,
want.
I can tell you right now, they don't. They don't need what they think they need to give them what they want.
Because they're basing their math off the 4% rule.
Yeah, but what the general industry is promoting, because again, the less you spend, the more they make. There's no incentive to let you to spend more. That's why the class exists, so that we can teach you how to find the right teams and to show you how much you can have if someone designs the right plan. Michael, the answer isn't what my friends say. The answer isn't what my internet is feeding me. The algos are feeding me. It doesn't matter what I thought a number I needed to. All that doesn't matter. You know what matters? The plan drives everything. And that's what we teach in the class. When you find the right teams that are building you a comprehensive plan, like one that does hundreds of iterations, risk mitigating all the potential risks, and we'll teach you what that looks like. It's hard. It takes a lot of time to run all those iterations to risk mitigate. But the plan, the math drives everything. The plan, not your emotions. It's not your feelings, not what you think. It's not what your advisor thinks. It's not their opinions and feelings. It's not the internet, what it's feeding you from the algorithms feelings. It is what the math says. It's up what the plan drives everything. It's a math problem. All this is a math problem. So if you'd like to learn more on how to properly plan for retirement and find the right teams, you just need to attend one of these 8-hour courses taught at major universities. If you'd like to register, go to retirementplanningedu.org. That's retirementplanningedu.org. Thanks for listening to the Retirement Education Hour. Be sure to follow or subscribe when listening on Spotify, Apple Podcasts, or wherever you listen to your podcasts. And now, back to the show.
And as we talk about the psychology of what's going on with the markets, how that could impact investors and people who are thinking about retirement, Kirk and Michael, there is one thing that stands above it all, and you say that's planning. That can really be the antidote here. Tell us more about that.
Well, every time we say this, it's so critical. Everyone thinks they have a plan. Honestly, in all the advisors say they have some special software or special solution. I won't quote all the catchy phrases, the roadmap to remind, all that nonsense that you hear on the next 10 callers, or come, we'll give you this tax. Stop with the nonsense. Here's the problem, and I'm not picking on any of you, and please don't get offended. My job is not to have you like us. Our job as a charity is to put you in the best position to have the best retirement possible. And I can tell you, you have no idea what a comprehensive plan looks like. Very, very, very few of you have stumbled across the right teams and forced them to build you a real comprehensive retirement plan, because there is no incentive for these people to spend 50 plus hours iterating and doing all the risk mitigation to produce the maximum amount of income you can have without outliving it, protecting you against long-term care, protecting you against the surviving spouse paying ridiculous taxes when the first spouse dies because they go from married filing joint to single, Medicare getting more expenses as when the first spouse dies because it's means tested. There is so many variables to this. And to build an effective retirement plan, it takes 50 plus hours. It's not a software. It's not eMoney. It's not Right Capital. It's not Money Guide Pro. It's none of this nonsense where the intern literally spends 30 minutes and produces a 30-page probability of success in a dial that's green, red zones. I saw something from Merrill the other day. It's just nonsense. Even if you don't want to come to the class, go to the charity's website and watch the 30-minute webinar showing you what a real sample retirement plan looks like. And that's what we're doing in this class. We're teaching people what a comprehensive retirement plan looks like, what's included, what's important, what different levers you need to have so you know where to take your money from in different market conditions, how to minimize your taxes. There's so many strategies around filling brackets, not bumping brackets, when to Roth convert, when to give the money to charity, when to take your Social Security. That's a tax problem. Social Security is a tax calculation, not an online calculator. That's nonsense. It's a tax calculation. I'm speechless, Michael. It is so hard. People need, the reason it's an 8 hours master's level course is because we got to teach them what the plan looks like, how it's constructed, what the different levers that need to be included, why those need to be included to manage sequence of returns, manage all of these things. But then we got to teach them, how do you choose an advisor? How do you do background checks? When you interview them, what specific questions to ask? What are red flags? Based upon their disclosures, what do those things mean? What specific things in the plan you should be looking for, and what specific questions, like, if I'm starting to take my required minimum distributions and we have a market correction, what account am I taking my RMDs from? My forced distributions. We teach you the specific things that you need to be asking and looking for in your teams to have a successful retirement.
So not only is all of that covered in the class, and one of the reasons why the class is as long as it is, but one of the challenges very frequently is that people just don't know what they don't know. And you mentioned earlier the Social Security. I had an hour-long conversation with someone recently about they had all these calculators and spreadsheets, and they ran all these.
Mom? Did you have one with your mom the other day too?
All these different situations about Social Security and all the different claiming strategies. And I asked them, okay, so how did you factor in the taxes? So they had stacks of spreadsheets printed out. They have notes all over them. And I said, how did you factor in the taxes? I'm trying to get a sense of how they ran their numbers. And they gave me a blank look. And they said, well, what do you mean? And I said, okay, so you ran all of these calculations, but you didn't factor in any of the tax planning that goes into Social Security, which is one of, if not the most important aspects of determining Social Security. So they didn't even know to include the taxes in the equation. And so all the spreadsheets, all the time, all the calculations were immediately wrong. You need to know, first of all, learn what you don't know, then learn those things to understand what you're even talking about. And on top of all of that, to bring it back to today's show in general, you can have the best plan in the world. If there's not a team there coaching you to stick to it and understand how it works, why it works, to calm you down when things get choppy, we've seen people have the best plan in the world and they implode it because politics spooked them or because their neighbor lost a job and they were sure that was the sign of a recession coming, and they implode a brilliant plan because no one was there to coach them through it.
Yeah, friends, herd mentality, the algorithms all provide pressure on people to make mistakes. And really, I think that's the message of our charity, our radio show. You don't even know the questions to ask. You don't even know what you're looking for. I know you guys are really smart. The smartest people are sometimes the easiest people to be sold something because they are so confident in their knowledge and their ability that if they figure out what you want to hear, you're done. So you don't even know. That's the purpose of this class, is to help you to know exactly what you should be looking for, what specific questions to ask. It's to teach you the things that I'm promising you. I'm promising every person listening right now, you don't know. It's not what you invest in. That's not what's going to drive success. There are so many other variables. Let us just teach you how to be able to put yourself in a position to succeed by finding the right teams and asking the right questions and knowing what a real retirement plan looks like so you can have 7, 8, 9% withdrawal rates, save hundreds of thousands of dollars in taxes, retire earlier. So attend one of our 8-hour classes taught at major universities and colleges in your areas. We also stream them live from the universities when we're teaching interactively so you can ask questions too. So if you'd like to attend, all we ask is a $29 donation charity. I hope to see you there. Go to retirementplanningedu.org. That's retirementplanningedu.org.
Retirement Education Foundation is a fiscally sponsored program of United Charitable, a registered 501c3 public charity. Investing involves risk, including the potential loss of principal. Any insurance discussed in this show is backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Retirement Education Foundation is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Retirement Education Foundation. This radio show is paid for by the Retirement Education Foundation.